going to be very short. We're still using presentations, slides, PowerPoint, but I try to work it through as fast as possible because according to the feedback, I know that amongst you guys got first year, second year, third year students or mingles together. I may have to work through all the concept, basic concept, before I get to the more advanced one. So hopefully anyone who has studied financial statements analysis or accounting before, please bear with me in the first very short sessions. But it also, I think, is a very good warm-up when you look at the business and you go through all the very basic things. It's actually a warm-up for later. But the focus for today is this. So I think we got 19 people. So nice. I've got 5 tracks here. So we divide into 4 groups. Each will be 4 to 3 people. As I can see, you guys already sit quite nicely. So maybe 4 here, 3 here, 4, and the last row is 4. Okay. So the companies that I picked is Colgate-Palmolive. I hope everyone is quite familiar with the brand names. The reason is because I did a short analysis of this company before using spreadsheet and Excel, and as well as came to you see my last line, Excel line with all the intrinsic value point. So I think this company is a good company. It's not too complicated per se in the format of balance sheets. All of these are from 10Ks, so this is annual reports in the US. The items on the balance sheet is not that hard. However, this company has a very diverse business model. Really, it only got 2 core segments, but it operates worldwide. So it's interesting that when you analyze such a company, you need to look at segments in different geographic as well. So I think that might interest you guys. We will do the second half, valuations. So anyone could tell me what are the main tools for valuations, like the valuation models that you normally use?
Discounted cash flow.
Yeah, that's the most popular one. Anyone else? Yep. Or rather, in more broad terms, multiples. And within multiples, you will have some different, maybe absolute multiples, maybe targeted multiples, or you have relative multiples. Anything else? Question? Oh, don't evade my answer lah, my question lah. Because Pengchen has went to ATP, so I expect him to know a lot.
No, I don't know anything.
Okay, so the last one actually is a very fundamental one. It's the asset value, right? People like us, youngers, we often fascinated by earnings, cash, growing. And we tend to forget that the balance sheet is actually where the company is coming from, right? So we need to learn a bit about asset valuations. So now I will hand all of these for you guys. Just don't be fascinated by it yet. Try to follow the slide. So 4 of you. Yeah, we got 5 years. Even though our model, I give you, Dick, you may want to sit.
Yang disabuk
Eddie and Sean, maybe you guys go over there.
Never mind, I just see from here.
You can. So
Never mind, it's okay lah. You all do. I just
This company is actually
I
suggested
think
by
it's
Steve, so Steve can skip, right?
yeah.
Yeah, this company was analyzed by Steve, so yeah. Well, I knew it as soon as I gave out the paper, both sides. It's very interesting, but please bear with me. You do PowerPoint.
Eddie, later you sit there. Eddie and Shan, you all sit there. Because we're blocked. Never see your face.
Oh, I should give you guys some time to get to know your group member. Will you introduce? Yeah. Oh, by the way, I forgot, these two papers that you got individually, it's a very simple DCF model. I'm sorry, the font is very small. It's really, nicely in the A4 size. And this one is for asset valuations. I just tell you before that later you'll do faster. Then basically you write down all the items from the balance sheet here, and then we do some adjustment if necessary. So this is exercise where we do together. In my phone, actually I just used the same case not long ago, so I'm as fresh as you guys. Okay, I want to keep the session more interaction, so I don't want to be too prepared. Okay, now we're gonna start our secondary training. Again, before you go into individual company analysis, you actually need to look at industry analysis. I cannot stress this enough because last time I already talked to you a little bit about industry. So, however, to go a lot deeper into this, actually you need more than just one company, let's just say. For example, Conga, you need, within the modeling, you see at least 4 or 5 main competitors. So if you want to get a view of the industry, you need to actually collect all of those 10 Ks that you have and read, understand how to compete with each other. Within the 10 Ks, Conga will say who are their competitors, and you need to take note of that. So understand the industry, like get a feel for it. Next, financial statement analysis, very basic. We're going to work through from liquidities, profitabilities, that sort of things. So, valuation, like I said, 3 methods, starting with asset values. Next will be earnings, powers, and lastly, we do multiples. So, history lessons. As I told you guys yesterday, I'm very interested in history. I always, actually, if you think about it, when you start analyzing something, what evidence do you have? It must be the past. All you have is past data. And I'm not talking about recent past data. You want to understand where the company was bought, why is it now, why is it become like it now. So you need to look through quickly history. Well, industry, I think everyone would know generally, this is the pictures where the industry, every single industry, and actually is applied apply for every single company as well. It's always start their introduction small. They're losing money, they're investing a lot, but they couldn't get back any. And then they go through the growth phase, they go through maturity, decline. Decline stage, this one, is generally for the industry, but not necessarily for the company per se. The reason why I'm saying this is some of the industry, they might have a very good competitive advantage that somehow they did not decline, they just mature. So from this point onward, they just go sideways. They do not earn super excess returns like they earn, 40, 50%, but they still earn above 20%. And especially for companies like the one we're going to analyze, companies, they are international companies, so they got huge growth potential, right? Beyond US. But still, the industry will still decline. Recently, all the big guys are going to go through consolidations. They're going to kick out all the new entries, small guys. They will die, and the industry will shrink. Okay, I think everyone is very familiar with Porter 5-Fox analysis. It's the basics industry tools, industry analysis tool. So you got, I want to draw your attention to this one, threat of new entrants and competitive. Those are the most significant factors within the Porter 5-Fox. So it's, all the 5-Fox is not equal, right? Customers, suppliers, and let's say order of important, threat of new entrants, competitive, substitutes, bargaining power of customer, and bargaining power of suppliers. So why am I saying this? That these two are the most important. Firstly, threat of new entrants. Right? This is the law of capitalism. If you happen to read Capitalism, it's the real book written by Karl Marx, a communist. But he wrote a very good book talking about capitalism. So capitalism is all about making money, profit, right? So if you make profit, new people would look at you and say, wow, you make so much profit, then you want to kick in. So threat of new entrants, let's say if you do not have any barriers here, what they call it barriers to entry, then people will start flocking in, right? And the rate of flocking in will kill any excess profit that you have. That's why it's so important. Not every industry possesses barriers of entry, so be very mindful. Competitive within the industry. So you got many situations. You could have companies, industry that have only a few companies that are strong. Let's just take soft drinks, Coca-Cola and Pepsi. Obviously, they're the strongest. They split the market shares, and since then they have a very what I call rational, competitive environment. They do not want to drive the price so low that neither of them get any benefit. They won't get into a price fight. That compared to, say, I heard before the start of this seminars, you guys talking about Samsung, Apple, right? Very exciting, 5C, 5S. The smartphone industry is hugely competitive. Okay, obviously you can see that. The first smartphone, obviously from Apple, it enjoyed excess profit for, say, when was the first iPhone out? 10 years, around that, right? So now, when the technologies is outdated, the patents start to, I don't know, they still got some patent. They just got into patent fight with Samsung last year, right? A very big fight, but as long as like people can mimic, right? Capitalism can mimic. And I believe that it was, if they do not innovate in such a hugely competitive industry, they will die. Doesn't matter how strong the balance sheet is, their reinvestment opportunity will run out. Right? products is also quite important because most of the analysts, when they analyze substitute products, they forget one thing, that they only analyze substitute products within the industry. Right? So say, pick Colgate and P&G, Procter & Gamble, everyone know that company? So they all make toothpaste, right? So you may think that, okay, you just compare between toothpaste, between Colgate, Palmolive, and Procter & Gamble, but you forget the Listerine, that sort of thing. That is a substitute product, right? So if your toothpaste manufacturers, you need to be aware of that. Just like if you're, say, car, so bus can be substituted to car, right? So you need to look beyond the industry to know what the threat of substitute product is. Bargaining powers of supplier and customer, I just go through it briefly. It depends on the characteristics of companies. If it's very, say, small, concentrated portfolio of products or services, which means it has very limited suppliers and limited customers, then those folks will become significant. And just to draw your attention to the 10 case, if your company has sales, like 10% of the company sales relies on one customer or say from one suppliers, they will have to state that. So whenever you analyze a company in your industry, take note, right? Read the 10 case. They will have to say whether they heavily rely on one or two suppliers or customers. That's very important. Next, moats. This is a concept. Actually, the term is coined by Warren Buffett. He was talking about a company as a castle. Then around the castles, you need to use moats to protect against what I just said, the threat to new entrants, to protect all those excess profit that you have. So I want to go through moats first because it's a very broad concept. It could exist in the industry or within the company itself. So you need to be very mindful because if you can find a company with moat and that moat does not deteriorate or very slow, you just find a great investment opportunities. And for such a company, all you would worry about in that investment is which price you pay. Right? The quality is there. And you know it's going to be there for a very long time. These are some examples of what could constitute a moat. Regulations, obviously, it means the government actually limited the number of companies that can operate in this industry. I don't know, in Singapore, you have any? SMRT, maybe? Yeah. So the government protect them. As long as the government is there, it will be protected. So I take another example from US. Is the casino. Right? Nobody likes, no government like casino. Everybody like casino. So the state government, each and every state in the US, they actually regulate very heavily this casino. So if you buy into a casino within a state where the regulations say we only need 5 casinos, and you're the biggest one in there, and not likely that the regulator is going to change that, you get a very good company. Patents, like I said, is you invent something and you register and it becomes yours. That inventory nobody can copy you. However, sadly, it's not protected forever. Right? It has limits. Say, I think drug company has patent around 20 years, and after that, on the so-called generic drugs companies, that means they can buy these drugs, they go home, they split them out, they study the chemical in them, and they imitate. So after the patent wears off, they're very mindful, especially for anyone who are doing healthcare and drugs, because as soon as the patent wears off, your company will face trouble if it relies so heavily on that one product. Pfizer faces problems once. I think think they have like 2 billion sales, which is 6% of sales in one product. It was so profitable that they relied heavily on it, and as soon as that patent goes out, their revenue back. Right? So be very mindful that they have rolling product lines behind it. We call it drug pipeline to replace the revenue that might be off where the patent is no longer there. Unique assets, as the name said, your company is lucky, say, enough to have a very unique asset that cannot be replicated. A good example would be rock quarries, right? So if you have the only quarry in the town, right, it means they go and take the rock under that, from the construction. Most likely you'll have that asset, nobody would care to even replicate that because it takes them too much money to moving rock around. Unique asset could be, I don't know, machines, locations, that sort of thing, where your company has and nobody else has. Those three, I purposely put them there because they are quite fluctuate, easy to change, need to be monitored, right? Just like I say, unique asset itself can be wear out, depreciations, patents, limit terms, regulations. If you happen to be in an industry which are under heavily regulated, which is casinos, utilities, right? You need to monitor the regulation trend. People on those senators, they actually sit together and say, hey, I don't like this company, and put some more tax on it. So be very, very careful. Brand. Brand actually a result. Right? All of these help create a brand. And the difficulty of brand is that it's very hard to quantify. It's very hard to quantify. As a financial analyst, we only be able to quantify a brand by looking at the returns. That means in the economic term, it's an exports concept. You cannot observe, you cannot predict. And the intangible asset, let's say not every company is very candid in terms of building those intangible assets. They play around with it a lot. Not all have real brand. Cost advantage, scale advantage is obviously, I think you guys already know, those so-called economics, average cost, MC, AC. Sorry. Right? So the company, if they can achieve a certain scale, right? If they can achieve a certain scale, they get benefit. Their costs will be spread. All the fixed costs will be spread. That's called cost advantage. It will be very helpful if you're thinking in terms of operating leverage, how much fixed cost, how much variable cost the company actually have. They're heavy on fixed costs. Be mindful that they have to achieve a certain sales volume to cover those fixed costs. So their financial result will be more fluctuating. Later I talk about the formula to calculate this thing up. Network effect is a quite new concept. You can think of Facebook, right? eBay. Network effect is something that if you put it in there, one user use, next user also use, then you get to a big scale that 1 million users use. Then nobody else wants to set up a similar network because they're already in there. Let's just say eBay. If you want to buy and sell within eBay already, you might not want to go to other website because you know there are tons of buyers and sellers within eBay. That is called network effect. It's related. Switching costs. This is most inherent in companies that have very high tech, like Stryker is a company that managing medical equipment, right? So they're managing the aluminum hip for people, old people. So those, if you want to implant these hips into the patient, you've got to have a certain expertise. So the doctors who are striker customers, they would have to learn how to do the surgery, and that creates a high switching cost because they don't want to save a couple of $10 and have to go around and learn how to implant things again, right? And in our school, you can clearly see that from Bloomberg terminal itself, right? Lots of analysts out there use it as a standard, so it gets high switching costs. Or even more simple, you can talk about Microsoft. If you're using Excel, PowerPoint, Word, you're used to it. Now suddenly you are asked to use another software, you won't use it, right? Very troublesome. Right? Company side up and everyone training in that. Last one, barriers to entry. It's also sort of created by all of these. And the decrease of barriers to entry, which I forgot to add, there'll be another barriers to exit. Barriers to entry, barriers to exits. The higher the better, actually. Basically, you try to keep all those little guys who try to come and eat away your profits. All must be resolved from only above. The stronger the moat you have, the stronger, the higher chance you can bury all those guys out. Here are just some pictures. I don't think you guys need to see it. Just to illustrate. Brand. Well, actually, that's very good, the brand. It may be a very good stock for your portfolio, actually, for a very long-term portfolio. Those brands, it has been around for a very long time. Right? They're very vital. They set the industry standard. Right? McDonald's set the industry standard for fast food. Right? Burger King, everyone else just imitate them. Okay. Network effect, barrier to entries, switching costs, size of competitive advantage. Here I only list a few signs. Just give you all so you guys can take notes. But there are more than that. And clearly, let's just walk through each one. High customer retention rate is not a very easy ratio to calculate, actually. Sorry about that. I really want this ratio to be calculated more efficiently, but sadly the company wouldn't want you to know this a lot. And it's only inherent when a company maybe they break out the number of customers for you. You can see this year we have 1,325 customers, something like that. Then you will know. Customer retention rate, how many customers actually stay with them? Oh, I remember, the industry that could use this could be a asset management firm. So anyone here doing the financial service sectors need to take notes. Asset under management, it will affect your AUM a lot. Let's just give you an example. The financial crisis 2009. Let's say a firm where they has very high customer retention rate, which means they got some, they call it sticky accounts. So all these are very loyal to the firms. They would stay. They won't withdraw the money, even in the financial crisis. Those firms will stay there, very strong. Compared to a company where they got customers keep on changing. Customers keep on changing hands, like switching firms. Those customers, very likely that they will flee away when trouble comes. So they will be very mindful. Pricing power, I think I have to use Coca-Cola's and Pepsi again. Or another would be, say, the Sotheby, the one that arts, they own the auction. I think they only have two companies. Can't remember. But basically, if you have very high pricing power, it's very good for the company. It means that they don't afraid of inflation. Right? They can, if inflation is 1%, next year they will charge 1% more. Within the high pricing power, how you calculate it? there will be some ratio, such as actually you costs. So you break down the expense, especially SG&A expense. Anyone know this? What this stands for? Yeah, administration expense. Basically, it's all the staff stuff, that sort of thing, or the cost of goods sold. So if you all see that all of these expense plus together, the total expense of the company, and you could divide that by, say, per transaction, if the company was servicing, or per customers, and you observe the trend. It would highlight if the company had pricing power. Rules of thumb, if they have pricing power, they would tell us it's obviously very good thing. The company will stay in the 10 case and really have pricing power, or you can look through all these things and you search for increased price. Did they increase price? The source of revenue, did they increase the price over the past 5 years? Look at the 10 case, see the pattern. If they can increase price and the revenue didn't drop, obviously they have high pricing power. Stability of market share. This one you can use Bloomberg to search for it.
Thanks.
Or you can use more traditional using the industry analysis. You have those HHY index. Oh, attention. The HHY index. I don't want to read the full name. It's very tricky or something like that. Funny something. So it basically takes the top 4% of the company. They got this kind of metrics to measure how concentrated the company is. And you need to observe this trend, whether this number gets bigger, and more entry, and they take away share from the incumbent, the company that's already in there. Stability is the key. An industry that has the most stable market shares has the most prospect for long-term returns. Again, Apple and the computer and smartphone industry. You could see huge difference if you compare a very mature industry such as, say, steel to market share in technologies. You could see that the leader keep changing. Right? IBM and Apple and now Samsung is chasing up. The market share is fluctuating a lot. So that's indicating to you the industry is very highly competitive. That's not good to be in for long term. You can be in and out fast, but not for long term. Good supply, good relationship. This is more of qualitative factors. You can try and judge them by. Actually, it's very hard for us because we're doing a US fund, and this you need to talk. Actually, pick up the phone and talk to the suppliers and the customer, or you pay the store a visit. Go and look at the store, what the product's like, how the customer or supplier react. If you get good feedback, that should be good. Careful though, don't be biased. If you ask one customer and he say, hey, the product is very bad, don't let that implant to you. You need to go search in the why areas or do the market survey. That's what the analysts would call due diligence. This can be found qualitatively. Okay, I work very fast through this. Basically, I want to walk you through a start of a business. So, you're young, graduate, you want to, you cannot find a job, right? You may want to start a hot dog stand. It's US term, hot dog stand. Although in Singapore, maybe you start a chop and tell something like that. Okay, you got the brilliant ideas to start a hot dog stand. You need money. Okay, very basic. Where you get the money from? Equities. You borrow from mom and dad, I guess. And you borrow from friends. Or you can go to OCBC, investment bankers, advise them for a project. Okay, then you get your money. How you use the money, right? Because we're talking about very simple manufacturing terms. So let's say you use the money to buy the inventories, get hot dogs. haven't had dinner, so I'm quite hungry. I'll go through this slide very fast. Okay, then you need to buy the fixed asset, which is your hot dog stand. Not a very asset-heavy industry business anyway. Most of it will be in the variable cost. Those cash inflow and outflow. So this, I think everyone heard the terms cash is king, right? I would say not always, and to be more exact, cash flow is king. Right? The cash on hand sitting there won't do anything. Cash flow, yes. A continuing stream of cash flow, that is king. Account receivables and account payables. So I don't think just quickly. So you can buy a cash and you can buy a credit as well as you can pay a cash and credit. That will create your account receivable and account payables. Okay. How does the business generate money? Obviously, sell hot dog. Give money, you get a hot dog. That's your revenue. Because you use the hot dogs, some of your material is gone. You get money, but your inventory goes down. You have the cost of goods sold. You get the first thing, gross profit. I hope I don't have to work these through very slow because most of you would recognize what they are anyway. What extent does the business occur? Generally, those three. Those fixed assets going to wear off. Not very fast. You're really gone. I don't know what brand is it. SG&A, invoice, your salary, you hire staff, you hire yourself, you won't have salary. Okay, and that will get you to EBIT. This is important. I want to stress that because what in the analysts they will say this is pure profit. Before it's alternate, like alter by accounting gimmicks or that sort of thing. Actually, it could be altered by DNA. That's why they have EBITDA. But I would say EBIT is a very pure profit from companies. You could use that to compare across industry and across country very well, because it won't take into account things that your corporate structure, which means how many debt you have, how many equities you have, and it won't take into account tax system as well. Because it's unfair, right? If you compare a US company with a Singapore company, tax rate is only 50%, there is 35%. EBIT is a pure profit, one of the most important numbers. They will call it, in US, they call it operating profits. What's money at this point? Okay. Obviously, you have to pay the debt holder first. Interest, the bank, sure, you're going to get that first. And if you have stock preferred shares, or you issue the bond yourself, you need to pay the corporate bond. These are in the ladders. So debt, this guy is the most important. You have to pay the bank first, then the bondholders. Okay. And you get pre-tax earnings after you pay both of these groups. Tax expense and net income. Here, Uncle Sam, take a lot, 35% corporate tax. After that, you get net income. I would say net income per se is not important, especially if you're looking at in terms of GAAP, which is a general accepted accounting standard in the US. Because it will be subject to a loss of manipulations. Right? So never, ever take the net income as it is. Right? Under GAAP or no GAAP. I don't care. Net income has to be adjusted always. Growth versus maintenance, capex versus investment. So you want growth, right? 1 hot dog stand to 5 hot dog stand. Later you take on the orchard road for hot dog stand. These are the investment instruments. So as in the business per se, you don't have to consider this, right? Unless your company is sitting on a huge chunk of cash. They don't have a chance to reinvest in the hot dog stand anymore. Would they have to think about other vehicles? But I wouldn't recommend though, because the company, actually I missed one thing, which is M&A. They can go around buy business as well. But organic growth, this term is very important, organic growth. You want the growth coming from this business where you get the highest return, where you know everything very well, compared to earnings from, say, buying a house, so consider all these three. You need to exclude them, right? When you calculate it, because the company will try and slip them in somewhere in the financial segment. You try to kick them out. Even interest at the bank. You put money in the bank, get interest, kick them out. Because that not be earnings from your business. That's where we want to be at. Another important concept is growth and maintenance capex. As everybody recall that the depreciation and amortization that make the TV wear out a few slides ago. Actually, D&A is just an accounting concept, obviously. It stated that you buy a building for $5 million, I have to depreciate them for 10 years. So take 5 divided by 10. Every year I take a little bit out. But is it true that I have to pay every 5 with like $500,000 for every 10 years? No, right? You don't have to pay out that cash. However, is your building really depreciated? It must. Your machine, you wear out, you use it, right? So think about this room, SIM, right? Imagine this room belongs to SIM. SIM is corporate, they got annual report. Anyone have read? Function, very profitable. I have talked to some of the professors. Actually, I said if SIM goes IPO, confirm I buy. Confirm I buy because it's very profitable. They're stingy. They didn't spend a lot of money to maintain the condition. Okay, it's still recording. Later, don't show the SM before.
Sure.
So, however, when you analyze a company, you need to break out growth versus maintenance. I think this is very important because most of analysts, and no, I can't say analysts, actually students mostly, they do not break out growth and maintenance, right? Because in the formula for free cash flow, what you do, you take operating cash flow, right? And you minus capex, as it is. It is the wrong thing to do, really. You need to know within that capex, how much money did I put into buying these 5 new hot dog stands? And how much money did I put back and fix the umbrella of my old hot dog stand? You need to break that out. Because this one, you won't count it in your calculation. It's fuel for your growth. You only count this one. So you only subtract this part of the capital expenditures out to find your free cash flow. So this is different from the formula you may learn in school. How? Later I will show. Then you want to expand, you have to issue more share or issue more debt. Don't be like that. So leverage or over expansion need to be mindful. The company can dilute the interest of the original shareholder. Right? I used to got you, me, and a few more, like 5 people. Now suddenly when you expand, you want to issue more shares, 10 more come in, eating into our own profit, that sort of thing. Issue more shares is quite a trickery things to say. Of course, it makes sense. If a business wants to grow, where they get the money from, they have to dilute some of the shares. However, as a financial analyst, you need to consider when you take into account growth, say net income and earnings per share. Right? If net income is growing, but your earnings per share not grow as fast, be careful. Right? When you're projecting the trend, you must take into account Will they issue more shares? When will they issue those shares? Why? What purpose? Do they really use the issue money or the money they get from issuing new shares to fuel growth? Or did they just use this as a tool to make compensations? Was it coming from options, or was it coming from genuinely go out there and get the financing done? Right? Need to take into consideration. So now analyzing the company, financial health, profitability, growth potentials. Actually, I want to add risk, but the concept of risk is very diverse. Let's just say, using Warren Buffett or value investor point of view, risk is the permanent loss of capital, right? So permanent risk of capital. So risk is not beta, just like last time we said, right? I just want to go sideways a little bit, talk about the so-called risk. You think about volatility and risk. Every company, like last time I talked about beta, this is the measure of volatility of the stock price, right? However, I don't think that's what's important, because the market is inefficient according to whatever I learned. But the volatility of the earnings or the fundamentals is important, right? You want your company to have earnings like, just like the stock price, somewhat like that. You don't want the earnings to, like, every quarter, like that. You don't want the earnings like that, right? Because it's very hard. We're going to forecast these earnings very far in the future. If your earnings is very volatile, it's tough. It's tough. Trust me, I tried. Airline is crazy. They just, this year they got money, next year they lose money, next year they get huge money, the next year they spend it all on capex and maintain all the airplane, and the money drops. It's tough to forecast with high volatility earnings. So say volatility as a concept to forecast, very important. In growth, and later we talk about growth. Okay, financial health. I think everyone is obviously, we start from balance sheet, current ratios, calculating cash, inventories, account receivables, account payables, short-term borrowing. Okay, and of course, I think everyone knows about the exit test, quick ratio, basically we pick out inventory. So here I want to pose a little bit and ask you guys, do you think a higher current ratio or higher quick ratio is good?
Yeah, quick.
Okay, I phrased it a bit wrongly. I mean, both the ratio can be used to measure the short-term coverage of financial health, short-term financial health. Do you think that it really serves its purpose, the quick ratio and current ratio? Does it really show that the company is good or bad? Rachel shake. Then Rachel, why?
Because you don't know how much of, like, let's say, what if you have, most of it is your accounts receivable. What if a lot of them turns into bad debt?
Okay. Well, that's a very good reasoning. Yeah, just like Rachel said, the components are also important. You need to know how much inside it actually is. However, so I go one step further. Do you think a negative is bad or good? That means the current asset cannot cover current liabilities. Do you think that the company has risk?
Change your marker. Your marker cannot see from the back. So change the one Sean's giving.
Oh,
yeah.
Okay. Sorry. Just continue my questions. Yeah, you think it's a bad thing? I have to say that. Oh,